For a couple of minutes, I'll give you an overview of the budget. And after that, Siddanna will take on the tax provisions and indirect provisions, and I will pitch in on every instance, expecting and trying to put in my thoughts on how does it impact the industry, how does it impact an individual. Of course, there are not many changes in the budget, but so Sidhu, would you be able to show the screen? Actually, the webinar screen is so clear, unlike other webinars we do. So many of us are paying a lot of attention on what is the budget, but seldom we pay any attention on what is the actual. If you see the entire fulcrum of the budget as employees of an organization or as directors of companies or promoters, wherever you are working, you will see one thing. Your system has become digital. So if the budget is saying 100, the actuals is hovering between 90 and 110. It's very easy to make a budget, and a lot of discussions happens on budget, but seldom people talk about the actuals. We should really work on the actuals because that is what has happened. Budget is only a provision. Whether the impact of the provision is good is what is vital to understand. If you can see here, center's expenditure has gone up at least by 10%. Not a very great sign. The center's expenditure cannot be going up so high because the hiring has not happened to that extent. Similarly, if you can see slide point number 3, interest payments have become almost 8 lakh crores. Though the budget was 8.1 lakh crores, the interest expense has become 8.05 lakh crores. But interest is a huge component for the budget, and that's why a lot of strain happens on the entire inflationary index and the entire tax provisions. That is where a lot of hit happens on that. And the other 3 points are quite minor when you see the larger numbers. It would be much easier for us to see the size of the mammoth budget where you are looking at a central expenditure only of this size. Go to the next slide, please. This is a good sign for us. You may see that the capital budget has gone up by 5.54 lakhs crores was the budget for capex, while the actuals was 5.93 lakh crores. That's quite expected. Such a small variation has not happened before in the capex in many of the budgets. If you go back to the budgets of the last 15 years, this is one of the best variations we have got. Similarly, granting aid for creation of capital assets. These are the monies what the government gives for example, you are creating a large MP's fund. Out of MP's fund, they are creating a school or they are creating assets. So if you see here, the capex has gone up to almost 8 lakh crores as opposed to 7.73 lakh crores. There's a 0.5 lakh crores, 50,000 crores, which has gone higher in the capex budget. It's a good sign. That's a good sign of economic development in the country. If you see most of the advanced countries, even if it goes to countries like US and things like that, only the defense budget goes up. The real infrastructure development is already settled and streamlined. If you see the number of roads which are coming in, the Vande Bharat Express coming in, the new airline investments happening, the portions of investments which are coming into the other sectors. So this is a good sign for us. Next one, Sidhu.
Mr. Go, so sorry to interrupt you, sir. A few of them are dropping message that your voice is very feeble. Can you please be a little louder?
I'll try, sir. I'll try to do that.
Yeah, and also can you
is it audible now?
It's now clear, sir. Can you? And people are also saying that they are not able to see the screen. Can you check whether the screens? I'm able to see the screen.
Even I'm able to see the screen, but it's not a worry. No, because these slides only see this screen is a more important screen. Whatever I am saying, it's not many numbers, many screens also. You can ignore that also. So if you can look at the overall thing, the capital budget has gone up. That's a good sign for the country. It's a developing country. Our defense expenditure is going up with a threat from the neighbors. And this is a COVID year. Mind you, COVID year, there was an amount of vaccinations which went on. That was going as a revenue expenditure. But for doing that, there was a lot of capital upheaval happening in the entire country. So that's a nice sign that includes artifacts like the Sardar Vallabhbhai Patel thing, or a Moreta Stadium, or the Golden Quadrangle roads getting into the way. Or, for example, if you just take the Bangalore-Mysore highway, I'm speaking from Bangalore, That's a project of 1800 crores. So the entire growth happens from there. But the concern is this portion where in a budget, you have, even you are at a home effort, you are earning a lakh of rupees and you tell, okay, my expenditure is 80,000. So my saving is 20,000. So you take a policy and when you are having your own personal money, salary earned or income earned minus expenses is equal to saving. But unfortunately, in a democratic environment or a republic environment, what happens is it is the other formula around. Expenditure is first, minus taxes collected. So there is an expenditure minus taxes collected, there is a shortfall. This shortfall is done by borrowing from people. The government borrows from treasury bonds, the RBI borrows on RBI bonds or external debts. Unlike a neighboring country, which has just got such a huge borrowing, our borrowing has been the best in the last 20 years. In 20 years, we have never had excessive borrowings. We are comfortable. In fact, the rates of IMF are going down everywhere. We are much more comfortable than any other country, and the country has enough resources. Yes, there is a little worry from the disinvestment point of view in public sectors. That is a very tiny amount which is coming to the overall fiscal deficit. If at all we push in more about the disinvestment sector and if the public sectors get disinvested, there would be a lot more benefit for the shortfall. So in nutshell, expenses minus the taxes collected is a shortfall. Expenses minus taxes collected shortfall. This shortfall is made good by borrowings and some grants. Our borrowings are very good rates. We have extremely high reputation in the international market. But if there can be a disinvestment which is done at a higher pace, like the LIC was a disinvestment, but a very small one. If there is a larger disinvestment, now a lot of railways are going private sector. I was in the Teja Express in Ahmedabad to Surat. It's as good as any of the European rails, and maybe the Vande Bharat Express is much more better than any of the Euro rails for the cost of money we pay. And if you mind the fiscal deficit, I'll give you an analogy on the fiscal deficit. The fiscal deficit happens in any developing country as long as it is in manageable limits. We are not doing great as expected, but at least we are not doing bad. The country is growing, so the fiscal deficit will increase. If the fiscal deficit has to go short, if you can reduce the fiscal deficit, what happens is there is a stark difference in the story, I'll tell you. Now you go to a Euro rail or you go to a Amtrak in US or you go to the Japanese rail. I'll give you a mathematics what I used to follow. I traveled from Zurich to a place called Lucerne in train, and it costed me close to 12,000 rupees for 600 kilometers or 13,000 rupees. I went in a regular class. I didn't go in the first class. But at the same time, when I traveled from Bangalore to Chennai, where I travel to Chennai quite often, when I travel from Bangalore to Chennai, it is only 1,500 rupees, including food and Wi-Fi and infotainment. And the class of the trains we go is much higher. Now, when you see a socialistic republic, the amount of money we can recover from tickets is so much more lesser. It is priced. Even today, railways undergo a loss because the pricing is done in such a way that people can afford it. That is a large part of the fiscal deficit. Sidhu, next one, Sidhu. And if you just see the small note, where does the money come from? Only 2% we take as non-debt, 4% comes from customs, 6% comes from non-tax receipts. To just give you an example, your FASTag, what you pay in the National Highway Authorities, could be one part of it. Excise duty is 7% and the income tax is 30%. That is the largest component. 17% is the GST, but this is the worry for us. This 34% is coming from borrowings. That is the biggest worry for us. If that can be 25% or 24%, it will be fantastic. But if it goes to 34%, it is a worry. That is the reason of hiring of the interest rates, a much more inflationary economy. But to that extent, you can also consider and have solace to the fact that all the services are subsidized. You get a metro train at 8 rupees to 10 rupees or 20 rupees, while in abroad they pay $20 or $15. So if that, because of that subsidized thing, the rupee coming from that sector does become quite a hit. And where does the rupee go? Pension subsidies, defense is 8%, etc., etc. This is not a much thing. We know where money goes. It goes for government schemes. It goes for finance and commission. And states get a share. I think that's about it, Sidhu. Now you can take the clear slides and I'll pitch in where it is required. And
Thanks, bro.
please make sure your PPT is visible because yours is law, mine is not law.
Thank you, Guru. Thanks for your detailed introduction of the budget allocation vis-a-vis the actual amount spent. That was quite interesting to see and know. And happy afternoon, all participants. And I hope my voice is clear and my screen is visible. Anybody, if you can confirm, it will be helpful.
Yes, sir. We are able to see the screen along with we're able to hear your voice clearly, sir. Thank you.
Yeah, thank you, Mr. Mohammed. Thank you. Now the topic for the day is the Union Budget 2023, what it means for the businesses and taxpayers. And obviously here we are not going to discuss what is the budget allocation for defense, what is the budget allocation for infrastructure, and what is the proposed or expected physical deficit or the monetary deficit. We are here to discuss only on the tax proposals. When I mean tax, tax may be tax or indirect taxes. Direct tax, we have only income tax now. And indirect taxes, obviously, we have GST. There are few proposals for in the customs also, but those, due to the paucity of the time, we are not discussing. We are discussing only on income tax proposals and GST proposals. So now, as we proceed for the purpose of this, firstly we will go through the income tax proposals in direct taxes, and for the purpose of simplicity, we have broadly categorized our entire topic into four: personal income tax. What is the change? What is the implication? Business income, and then we have a couple of amendments which are proposed in charitable institutions and for cooperative societies. So let us see what is there in the current budget, particularly for the individual class of taxpayers. As you see, the taxation for individual taxpayers were pretty simple 2 years back. Simple in the sense, because the law has evolved over a period of time. The slab rates, there were tweaking of the slab rates and changing the tax rates and all those things, but overall principles remain same over a period of time, because there were so many host of the deductions or the exemptions which are allowed to the individual taxpayers. But in the year 2000, in the year 2020-21, financial year 2021, there was a proposal in budget, annual budget 2020, finance year 2020, to introduce a section called as 115 BAC. This was only for individual taxpayers, and now that was broadly, or in the industry parlance, it was called as a new regime for individual taxpayers. So what new regime told is, in the old regime, you are allowed a certain amount of deduction. For example, let us take a salaried employee. Salaried employee is allowed a deduction under section 10, subsection 13A for house rent allowance, and he is allowed for LTA leave travel allowance under subsection 5 of section 10. And then he can claim the reduction under ATC, ATD, ATG for charity donations, ATC, CD, and all other things for that. But government felt that this entire structure is quite cumbersome, and it is not. At times, it may not be feasible for some of the taxpayers. So, to make it more productive, what they did is they told that under the new regime, you are not allowed to claim any deductions, but you are eligible to pay the tax at a lesser rates. That is how the entire new regime came into the proposal, and it became an act. And this old new regime was kept as an option for the taxpayers, meaning by default, it is presumed that you are paying the taxes under the old regime. But if you want to switch to the new regime, you have to opt for it by filing a form. 10I, 10C or 10D or 10E forms were there. Those forms were required to be filed before filing the tax returns. But over a period of 2 years, even government felt that this entire scheme is not so encouraging. Most of the people were not opting for this scheme. Still, so many individual taxpayers, they were opting for the old scheme by claiming the deductions. Because in case if you are staying in a city like Bangalore or any other metro cities, either you will stay in your own house or you may have the rented house. In case if you have a rented house, you can claim the deduction for HRA. In case if you have own house, you can claim the deduction for the interest and the principal paid under Section 24B and under Section 80C respectively. So now the government felt that the new tax regime, most of the people were not using, and the entire object, you see, the overall Indian economy, the Indian psychology of the Indian citizens is that we believe in saving. For example, if we have an earnings of 100, around 30 to 35, most of us, maybe 40 in some cases, we used to save for our retirement, for our children's education, and for long-term objectives. But in most of the developed countries, the focus is on spending, not on savings. So whatever they earn, most of it they will spend. When they spend, there will be a growth in the business or the services, because when you spend, the industry will grow. So that will be represented or reflected in the growth rate, annual GDP and the other things. So even government of India felt that we should promote spending now. The people, when they earn more, they should spend more. And because of that reason, some of the investment linked deductions, for example, there were certain deductions which were there in the income tax law. For example, ATC, PPF is there. Tax saver mutual funds were there, tax linked FDs were there. You invest and you claim the deduction. So many people felt that, okay, in case if I am putting 1 lakh rupees in tax saver mutual funds, if I am in 30% slab, I will get outright deduction of 30%. I am investing only 70,000 rupees, and for 70,000 rupees, I am getting the benefit of that. So many people opted for it, but the government felt that people are not spending their savings. So they have made changes in the new regime. I am telling you, there are no changes which are proposed in the old regime. Old regime remains same. Whatever changes we are discussing now, that those changes are in the new regime. You may have any queries, you can note down your queries. We will discuss it over the end of the presentation. We will have a Q&A session. So now, what is the proposals which are made in the new regime? If you can see on the left hand side, existing slabs were there. This is I'm discussing on the new regime, and existing slabs were there. Now proposed slabs are on the right hand side. Existing slabs, 2,50,000 was the exemption limit, and 2,50,000 to 5 lakh, it was 5% tax rate. And for every increase in 2.5 lakh, there was an increase in tax rate of 5%, 10%, 15, 20, 25, 30. In case if somebody has an income of more than 50 lakhs, 30% tax rate. Now in the new proposed slabs, what they have done is the 2.5 lakh has been increased to 3 lakh rupees. And from there, every increase of 3 lakh, there is an increase of 5%, 10%, 15%, 20, and after 20, 30%. The 25 slab rate they have removed it. Earlier there were 6 slabs in the new regime, and now they are 5 tax rates. So the basic exemption limit is 3 lakh, 3 to 6, 5, 6 to 9, 10, and then 15, 20, 30%. And this 3 lakhs exemption is for new regime. For the old regime, still that 2.5 lakh will continue. And other things, certain other things are there which are made, the changes were made in the new regime. That is, earlier new regime was applicable only for the individual class of taxpayers. Now it is extended to AOP, Association of Persons, Body of Individuals, and Artificial Judicial Persons also. These changes are effective from next financial year, assessment year 24-25, financial year 23-24. And as I told, now the new regime is a default. By default, it is presumed that you are opting for the new scheme. Any of the individual taxpayers, they may be salaried class of taxpayers, they may be other than salary business class of taxpayers, or they may be a combination of both salary as well as business and profession. Anybody, any individual, by default, it is deemed that they are opting for the new scheme. So does it mean that old scheme is not there now? It is there, luckily it is still there. But if you want to go for the old scheme, you have to opt for it. And that option has to be exercised before filing the tax returns. And obviously there will be a filing of some form which will be notified over a period of time. And one more thing is, under the new regime, there were no deductions which were allowed. No deductions, only 3 deductions were there. One is 80CCD, 2 deduction perhaps, earlier regime, 80CCD 2, that is in case if our employer is contributing to the National Pension Scheme NPS, that was allowed as deduction, and 80JJA for 80JJAA for business class of taxpayers, where you have the new workforce which you had during the year. Only those deductions were there, and there was a standard deduction of 50,000 rupees, which was allowed only for those who were opting for the old regime. That was not there in the new regime. So this regime, in order to make the new regime more attractive, they have introduced this 50,000 rupees to the old new regime also. So now the new regime will have this 50,000 deduction. This 50,000 standard deduction under section 16, subsection 1A, it was there for old regime. It was not there for the new regime, but now it has been into the, now it is proposed to brought into the new regime also. And earlier there was a rebate of under section 87A. For example, anybody who was having an income of up to 5 lakh rupees, he need not pay the tax at all. Up to 2.5 to 5 lakh in the old regime, 5% tax was there, but there was an exemption, the rebate under section 87A, but that has been extended to 7 lakh rupees, and this is only for those who are opting for the new regime. So in case if somebody has around, somebody is a salaried class, an employee working with a private limited company or any private or public sector, and if he has a salary of 7.5 lakh rupees, he need not pay any tax, because 50,000 rupees he will claim the deduction under, he will claim the standard deduction. On 7 lakh there is no tax because there is a rebate. And one more section they have introduced, for example, as you know, the NPS, how the NPS scheme works is, the employer's contribution will be there and employee's contribution is there. This is similar to the retirement benefit under PF, both employer and the employee will contribute to the fund. One more fund they have introduced now, which is called as Agniveer Fund. This is for the armed forces who are enrolled for under Agnipath scheme in the armed forces for 3, 4 hours, 5, whatever the time limit is there. In that case, the individual armed forces personnel, they will contribute to Agniveer Fund, their contribution, and central government will also contribute equivalent amount to the fund. Both Agniveers, that is their armed forces personnel's contribution, as well as central government, is allowed as deduction even in the new regime. So in the new regime, we have 3 deductions now. One is 80 CCD to employers' contribution to the national pension scheme, 80 CCH for Agniveers, and third one is 80 JAAA for business class of taxpayers. And one more thing is, for individual taxpayers, the surcharge was pretty high, up to from 50 lakhs to 1 crore, 10%, and then 2 crores to 1 crore to 2 crore, 15%, 2 to 5, 25. And those who are earning an income, taxable income of more than 5 crores, the surcharge was 37%. 37% of the tax, and the effective tax rate was more than 44%, and this is one of the highest in the world. This is what Mr. Finance Minister was mentioning in her budget speech. So the high net worth individuals who has the income of more than 5 crores, they felt that this is a huge amount of tax that they were paying, and this is only a tax on income. When they spend, they have to pay indirect tax also in the form of GST. So they felt that the tax was really discouraging for most of the higher class of taxpayers, and in order to encourage them, the surcharge rate has been reduced to 25%. Now the overall surcharge limit is 25%. Maximum amount of surcharge is 25% for individuals, and this is also available in the new regime only. In case if somebody is opting for the old regime, 37% surcharge will still continue. So these are the changes which are made in the new scheme. The new scheme is default now, and the standard deduction is allowed for 50,000 rupees. 80 CCH is allowed for Agniveers under the new scheme, and maximum amount of surcharge will be 25%. These are the proposed changes in the new regime. But as an individual class of taxpayers, you have to see which of the scheme was for you. For most of the taxpayers, particularly who are in the middle, in between lower and the middle, there may be this new scheme would be beneficial for them. But in case if you have high amount of investment, maybe around more than 3.5 or 4 lakh rupees, old scheme may still continue. But in the new scheme, there are no deductions allowed under 80C, 80 CCD, nothing. Only deduction allowed is standard deduction, 80 CCD 2 for National Pension Scheme, 80 CCH for Agniveers. Now, how this new scheme works? Let us take an example of the person who has the business or professional income. If he has already opted for the new scheme by filing Form 10E before the start of the financial year 23-24, he will continue to pay the tax in that scheme because he has already opted for the new scheme. In case if he has not opted, new scheme for him will become a default scheme. But in case if he wants to go for a old scheme, he has to exercise this option, has to file a prescribed form. This option has to be exercised before. Once he exercises, he cannot withdraw this. Once it is allowed. So, for example, somebody is in the business or profession, and if he wants to opt for the old scheme, he can continue for 2-3 years, and then once he comes out of that new scheme, he cannot go back again. So this is for those who are for individuals who are having a business or professional income. For those who don't have the business or professional income, for salaried class of taxpayers, you may pay the tax under the new scheme, which is a default now. You have the option to go back to the old scheme, and this option has to be exercised. Old scheme, if you want to opt for it, it has to be exercised. And for individual who salaried class of taxpayers, the switch in, switch out is allowed every year. You can opt for this year, you can opt for a new scheme, and then you can go back to the old scheme, and that permutation combination is allowed. Now, for some of the employees, if the employer is giving rent-free accommodation, if somebody is giving an accommodation without any rent, without charging a rent or charging a concessional rate, the differential amount was charged as a perquisite in the hands of the employees under Section 17, subsection 2. There were the rules or the prescribed methods for determining the perquisite value, which are there in Rule 3 of Income Tax Rules. And in case if the accommodation is owned by the employer or it is hired out by the employer, if it is furnished, unfurnished, the rules were there. Now those rules have changed. The new rules are going to come. But this is one amendment which is there in the which is proposed in the law. The rent-free accommodation value of perquisite for rent-free accommodations have changed now. The new valuation rules will be notified soon. This is one of the important amendment, particularly for individual class of taxpayers who are engaged in any business or who are engaged in any profession. For business class of taxpayers, who is the person who is engaged in, let us say that there is a small businessman who is engaged in sale of goods. He is not engaged in any profession. So for him, he has to pay the taxes, he has to file the tax returns, and he has to maintain the books of accounts. He has to maintain the records for the receipts, the payments, the income, the expenditure, and all those things. Over a period of time, for small business person, it was very cumbersome and difficult to maintain, and he has to go for the external consultancy for hire any other consultant to prepare books of accounts and other things for them. Similarly, for the profession, so the government felt that to give some relief to this small business of persons who are engaged in the business or profession, they had much before in the income tax law, they have introduced two sections. One is 44 ADA and 44 ADA, under which the tax will be paid under presumptive basis. Presumptive basis in the sense, in case if I have a turnover of say 1 crore, 8% of my turnover shall be deemed to be the income, and on which I have to pay the tax. Similarly, if I'm in the profession, if I have the income of say 40 lakh rupees, 50% of my income, 50% of my receipts shall be deemed to be the income, and I have to pay the tax on that. This were the provisions.
Sidhu, can I interrupt?
Yeah.
So sorry, sir. This meeting tab is is blocking the text. Can you press on the hide so that it goes away, sir?
There is one hide button, Sidhu.
Yeah.
Can you click on that, sir? Yeah.
Thank you.
Thank you, sir.
Just to add to Sidhu, whatever he has told now, the purpose of doing this has to be done on 3 bases. The 3 fulcrum of arriving at this, and as and when you go further, you can see a lot of changes happening in this phase. We'll have to understand the overall construct. 3 years ago, they told tax audit is not required. So the government told there is no need of any tax audit. So people are wondering what is the need for having this when auditors are there, they can do a tax audit. Last year later, they told no need of GST audit. There is no need of a GST audit at all. Then as and when you go back and see, file your income tax return now, the moment you put your PAN number, you get a whole lot of data already in the department. What is the data available of each of you will come in the department. So if X has got mutual funds, it comes in the income tax website. If X has sold shares, it comes in the website. If X has purchased a land, it comes in the income tax portal. So if you go and see the entire access, how it is happening is, first a tax audit went. They made it easy for people to do business. Next GST audit went. They made it more easy for doing business. Next, incorporation of companies became very easy. It can be done in 2 days now. It's a part of ease of doing business. Now, along with incorporation of companies, you get PAN number, TAN number, GST number, Provident Fund number, ESI number also. So you get 5 numbers easily. Now, if you come and relate that to this provision of law, where the government is telling us, if you see a profit and loss account, the right side are the sales and the left side are the expenses. Most of the sales are covered under GST. Whatever you sell, you file a GST return and it will be a GST output for you and input for the customer who is going to buy from you, whether it is a small business or a profession. Similarly, all your expenses in the left side of the P&L account is covered by GST or tax withholding, TDS. So any payments you make, either you have a GST payment or you have a TDS payment. If you see the analysis of your personal profit and loss account, 90% of your profit and loss account will either come under GST or TDS. Now GST portal is getting better, TDS portal is getting better. Actually, it is much good when compared to 10 years ago. It's become so seamless now. So the government almost knows your entire debit and entire credit. And again, when you go to the income tax portal, your AIS, that is the annual information system, almost gives out every data. So if you go back to my first starting introduction, the expenditure in recovery is becoming better. That is why there are not too many tax changes. If you go to this tax change, they're making it on the ground that you don't have to file income tax returns. You just file a presumptive taxes. You pay 8% and be done with it, because either way your P&L is already mapped by the government in the GST portal and the TDS portal. So this is another method to make ease of doing business. So I'm sure it will go a long way in helping up. Sidhu, please take up the next one.
Yeah, thank you so much, Guru. And as you said, in budget speech, FM Madam was telling that the average time taken for processing the tax returns now is just 16 days, as against 79 days, which were there in 13-14 financial year. And 45% of the tax returns are processed within 48 hours. So in our office also, we have filed the tax returns in next 10 minutes. The income tax return was processed and we got an intimation under 143(1). So that is how the income tax department entire infrastructure is working. So that is a good thing which is happening particularly for the taxpayers. So I was discussing on the presumptive taxation for individuals. So somebody who is a small businessman who has a turnover of up to 2 crores earlier was allowed to opt for this scheme, this presumptive taxation scheme. Now the 2 crore limit has been extended to 3 crores, provided the turnover, that is the receipt from the business, that is receipt out of sales or turnover, the receipt should 95% of the receipt should be in any form other than cash. It may be through digital payments, and the government want to discourage cash transactions, and hence 5% cash transactions are still allowed. Invariably it will be there. So in case if you are doing a business and your 95% of your transactions are, receipts are through the banking channels, so the limit is extended to 2 crores. And similarly for professionals, the limit was earlier 50 lakh rupees. Now it is extended to 75 lakh rupees, provided your cash receipts are not more than 5%. So these are the two things for under the presumptive taxation scheme. There are a couple of changes which are proposed in the capital gains chapter. This is quite interesting. See, in case if you have any residential house property, and if you sell it and purchase another residential house property within the time which is prescribed in the under the provisions of section 54, that is 1 year before, 2 years after in case of purchase, or 3 years in case of construction. So you were eligible for exemption under 54. Similarly, in case if you are transferring any asset other than residential house property like jewelry, or it may be a commercial property, or it may be open site, or it may be shares, equity shares of any company, and you are investing in the residential house property, then the exemption was allowed under 54F. But in that, under both 54 as well as 54F, there was no monetary threshold limit. You purchase any property worth any amount. If you are purchasing a property of 15 crores, 20 crores, still it was allowed as deduction. Now they have got in the monetary threshold limit. Any exemption under section 54 or 54F, the amount in the new residential property, if you want to claim the investment, if you want to claim the deduction and by making the investment, the monetary threshold limit now is 10 crores. This may be discouraging, particularly if you say, for example, somebody who has a startup, who is a founder of a startup, and it typically happens in case of a startup, there will be an angel investor. In secondary exit, whenever there is an angel investor which they want to purchase the shares from the existing founders, they will sell the shares, and when they sell the shares, they want to put it in the house property, and they may buy the property worth more than 12-15 crores also, but now it is only 10 crores. This is the limit. And earlier, in case if you have sold any property, individuals, house property or any land or building, the deduction exemption was allowed under 54 EC. In case if you have sold any property and if you're putting up to rupees 50 lakhs in bonds, this is commonly known as 54 EC bonds. The exemption was allowed up to rupees 50 lakhs, and one of the bond which was notified was the bonds issued by National Highway Authorities of India, NHAI. In addition to that, Indian Railways bonds are there, rural electrification bonds are there, but now NHAI bonds, they have removed it. They have taken out from 54 EC. Maybe going forward, they may notify some other bonds, but as of now,
Yeah.
NHAI bonds,
Sidhu,
they have removed.
and the other logic of removing the NHA bonds is, if you see most of the national highway authorities which are coming under a public-private partnership.
Correct,
If you see
correct.
Hyderabad to Anakapalli, if you see Hyderabad to Bhimavaram, there would be a Tuni Anakapalli highway. The road between Bangalore to Mysore is a public-private partnership. So it's actually a revenue earning model. Just a
Correct.
trivia for you before going there. Earlier, the national highway, a toll collection per day used to be only 70 lakhs across India. But now, after the FASTag has come in, the collections across India is coming to some 13 crores per day.
Oh.
Where is 70 lakhs and where is 13 crores? So that is why NHAI is also having a larger share of money. Taxes have improved because of this. All of a sudden, you cannot tell the traffic outside in the national highways has gone up to that extent. Everything used to come in cash, and the collectors would not even pay money to the government, and they just pocket up the money. Now, a simple thing like a small FASTag can change the model itself. And going forward, the next year, I was reading one of the budget speeches. The new highways which are coming in is almost coming to some 7,000 kilometers.
Oh.
If 7,000 kilometers trackways are going to be there, that can be a huge revenue earning potential for the government without expenditure, because it's a PPP program where the private enterprises will put in the money on a revenue sharing basis. That is one reason 54E has NHAI bonds has been removed.
Yes, Guru.
So please continue.
Yeah, in case if the NHAI itself is self-sufficient, self-reliant on their financials, then it may not be sensible for them to issue the bonds and pay unnecessary interest on that. Maybe because of that reason, they have removed this. And they have introduced one more new section 50A. See, there are certain debentures which are these are commonly known as market-linked debentures. On these debentures, the interest rate is not fixed. It varies. It varies on the market movement. So the government felt that since these are not similar to the traditional or the orthodox debenture instruments, hence the tax rate should be different for this. So now what they have brought a new section 50A for investment market linked debentures, where the interest varies. Any capital gains arising on the transfer of these market linked debentures is always short term, irrespective of the period involved. It may be 1 year, 2 year, 3 year, 10 years, whatever it is there. If you are purchasing and if you are selling it, is there any difference in the market linked debentures? The capital gains is always short term, and cost of acquisition, cost of transfer is allowed. Index in case of long term capital asset, indexation is allowed under second proviso to section 48, but that is not allowed either way for debentures. Interest indexation is not allowed. So for market linked debentures, short term capital gains without indexation. And one more thing is, whenever you are selling any property for capital gains, property means capital asset. We generally call it as a capital asset, which is defined under section 2 subsection 14 of the Income Tax Act. It includes your residential house property or commercial house property. It includes jewelry also. It includes shares, sculptures, any boards, yachts. All those things are covered under capital goods, capital asset definition. And the incidence of tax, particularly for capital gains, incidence of tax is on transfer. It is not on sale. The word transfer is defined under subsection 47 of section 2. Transfer includes sale. It also includes exchange. For example, I have a house and somebody is ready to sell the shares in their company. They are exchanging. They are transferring me the shares. I am transferring them my house property. There is no sale involved here for him also, for me also. But there is a transfer still, because there is an exchange. Exchange is also considered as a transfer. Now somebody has a physical gold, and that gold is converted into EGR, that is electronic gold receipts. These electronic gold receipts are freely traded on the recognized stock exchange now. So I have purchased a physical gold some 10 years back, and at that point of time, they may be 2,000 or 2,500 per gram. And now when I am exchanging it, physical gold for electronic gold receipts, by going by the definition of the transfer, I should pay the tax. Uh, Although I have not got any money into my account, still I have to pay the tax because there is exchange of shares. So government thought that it is necessary to bring in some amendment, and hence they have told that in case of conversion of physical gold into EGR is not treated as a transfer within the meaning of section 47, and hence within the meaning of section 45, and hence there is no capital gains. But however, in case if you sell the electronic gold receipt eventually, the cost of acquisition shall be the cost of the gold, and the period of holding shall be from the period on which you have purchased the physical gold. So this is one clarificatory provisions. There are consequential amendment to section 47 and 48 also. And there is one more interesting scenario. For example, if I have a house property and I have borrowed the loan for the purchase or for the construction of that house property, I may be paying an interest to the banker from where I have taken the loan, and there will be, I am paying the EMI to the bank, and that EMI consists of a principal portion as well as the interest portion. The principal portion is allowed as deduction under section 80C to the extent of that whatever limit prescribed under 80C, and the interest I can claim it under section 24B. Now, what people used to do is, I am taking the loan for the purpose of construction of the property, and I'm paying the interest. Interest I'm claiming it under 24B, and I have incurred the cost for the construction of the house property. That cost includes the cost of entire civil work and all those things, and it also includes stamp duty, registration charges, and other incidental expenses. I will add interest also to the cost, and when I sell it, the interest is becoming the cost of the asset. So I am taking 24B deduction also for interest expenditure. I am also adding it to the cost, and when I sell it, I will take the tax advantage in the year in which I sell. So there is double deduction under section 24B and as well as under capital gains chapter under 45. So in order to discourage this, now they have brought in the amendment to section 48. It says that section 55, this is an amendment to section 65, it says that in case if you have claimed any interest as a deduction under 24B, the cost of interest shall not form part of your cost of acquisition or cost of improvement. You cannot add it to your cost. And this was very much required. And now the cost of improvement, for example, if I have a goodwill, intangible asset, if I have a goodwill, or it may be brand name or trade name or anything, if it is self-generated asset, generated within the business or profession, the cost of acquisition for that is nil. But people used to claim the cost of improvement on that asset. Now they have brought in another amendment to section 55 saying that cost of improvement for intangible asset is also nil. So in case if I have an intangible asset, I cannot claim cost of acquisition. Self-generated intangible assets, cost of acquisition is also nil, cost of improvement is also nil now. And if I'm paying any interest and claiming a deduction under section 24B, I cannot take it and add it to the cost of acquisition for capital gains. Now this is interesting. The people now they after this, particularly during the pandemic, there are a lot of
Sidhu,
yeah.
can I just wait for? I'm sorry, I think I made a small mistake when I was talking a little while earlier regarding the national highway. What is the fast track collection which is happening? Earlier, the fast track collection used to be 65 lakh rupees per day. That used to be the fast track collection per day. Now it is becoming from 65 lakh rupees per day for the country. It has become 103.94 crores. That means it's 100 times growth. That means 100 crores you take per day for fast track national highway collection into 30 days is almost 3,000 to 3,500 crores. Last year alone, 55,000 crores the government has collected only on fast track collections. As earlier, it used to be 3,800 crores as opposed to 55,000 crores. The public are actually paying money, but it is not reaching the government. The highest fast track collection happened on 25th February 2021, which became almost around 170 crores per day. That is the highest fast track collection. So as I was going back there, the method of collecting taxes is becoming more and more interesting, more and more tech driven. As long as technology people are there in the country to give solutions, we'll see a lot more governance and a lot more taxpayers as we go forward. Sidhu, you can go ahead.
Yeah, thanks, Ulu. Thanks for the clarification. See, for any amount which is which income which accrues to any citizen of India, by winning from lotteries or crossword puzzles or for card games or any other game of any other sort. There were explicit and express provisions under the income tax law under section 115 series, which says that the tax has to be paid, and that there were tax deduction TDS provisions were also there, which were contained under section 194 BB. Now there were no provisions for online gaming. In case if somebody is winning the money, for example, after this pandemic, it has become a fashion. So many, particularly millennials and all, who have a lot of time, they pay this judo, ludo, Dream 11, rummy, dummy. So many are there. They will start paying, and some amount of, they win some amount of money. They will it will be credited to their user account, and from there they can withdraw it and they can get it credited to their bank account. These things were going on, but there were no provisions in the income tax law to get it. Nevertheless, this is an income, because there is no specific exemption which were there in the provisions of section 10, and hence it was an income, but there was no charging section for this, and hence 115 BBJ, this is a new section which has been introduced, and any winnings from online games will be taxed at a rate of 30% flat. No new regime, old regime, that concept itself is not there. 30%, whatever, 10,000 if you're earning, 3,000 rupees is your tax. There is no basic exemption limit, whatever scheme you are, no basic exemption limit, and no deductions under chapter 6, 80, 80C, 80D, there is nothing is there. So 115 BB winnings from online games after this judo lodo, whatever it is there, it is taxed at flat rate of 30% without any basic exemption limit. Now, if somebody is playing the online game and earning having some amount of income, it would be administratively difficult for the central government or for the tax department to go. It is not possible for them to take the police jeep and go to each and household and see whether you have played online, whether you was that is quite cumbersome. It is not possible for the country of the size of India. So what they did is, in case if anybody is playing online game and the company, that gaming company, if they are transferring any amount, they are supposed to deduct the tax at source. Now TDS has been introduced for online gaming. This is a new section which is introduced, section 194 BA, which says that the tax has to be deducted at rate of 30%. And when the tax has to be deducted, the rate of tax is 30%, obviously. Threshold limit is there, 10,000 rupees per year. This is not per payment, it is per year, 10,000 rupees aggregate amount. And the tax has to be deducted at the time when the amount is credited to the user account. Every time when you user account during withdraws, user withdraws that amount, you have to deduct the tax at rate of 30%. However, if the winnings are there in the user account but it is not withdrawn, at the end of the financial year, once you have to deduct the tax. And in case if the reward is in cash, partly in cash and partly in kind, and the amount of TDS cash component is not sufficient to deduct the taxes, the payee has to pay the tax first, and then he can encash his reward. So now online gaming is chargeable to tax. Income from online gaming is chargeable to tax, and the TDS, the online gaming company, all this Dream 11, MPL, and rummy, dummy, whatever it is there, they have to deduct the tax at source at rate of 30%. One more thing is, in case of any income, if somebody is paying 50,000 rupees to anybody, paying 50,000 in any amount in addition to 50,000 without any consideration, the amount for the recipient, it was taxed under section 56 to 10, 56 subsection 2 clause 10. But in case if the transactions was between the family, relatives and all, there is a specific exemption. But if somebody, for example, if I have a friend, he is paying me 50, 60,000, more than 50,000 rupees, it is income for me. And there are consequential amendment to section 2, subsection 24, which defines the word income. So that is my income, I have to pay the tax on that. Now, similarly, in case if somebody is there in India and they are gifting more than 50,000 rupees to somebody who is a non-resident. Now, for non-resident, income should be taxed in India only if the income is deemed to have been accrued and arised in India in terms of section 9 of the Act. So recently, in the year 2019, the provisions of section 9 was section 9 were amended to include that in case if any non-resident is getting a gift from a resident, from any resident, for a value of more than 50,000 rupees without any consideration, so that amount shall be deemed to have been accrued and arised in India. So he has to pay the tax on that. But these provisions were made applicable only for resident, non-resident. And there is one more category of taxpayers in India, the residential status in India, that is resident but not ordinarily resident. So that amendment was not applicable in the year 2019. Amendment was not applicable for resident but not ordinarily resident. Now they have brought in one more amendment to say that even if somebody resident in India is gifting to a person who is resident but not ordinarily resident for any amount more than 50,000, now it is taxable in the hands of recipient as income from other sources.
Sidhu, can you please clarify that if there is a non-resident who is staying outside the country and there is a blood relationship, Section 56 applicability?
In case if a relative still 56 to 7 to 210 would be applicable, Guru. I mean, there should not be, it should not be treated as an income in the hands of recipient. That will be there. This is only for those who are not related.
Go ahead, Sidhu. Go ahead, please.
And now, as I said, the government of India now they wanted the taxpayers to spend more, and savings has to be curtailed. See, any insurance policy, life insurance policy, if you see, there are various life insurance policy. There may be term insurance, there may be endowment policy, there may be a money back policy. Now, in India, if you see investment in LIC, that is life insurance policy, is predominantly it is taken as an investment instrument. This is an investment as well as an insurance instrument, but it is historically it is treated as an investment. So I will put some amount of money every year in the form of premium. So at the end of the year, if I die, obviously any insurance policy for that matter is rewarding only when the person dies. Otherwise, it is not an investment option at all. But some individual felt that, okay, I will have a policy also over a period of years. If nothing happens to me, I will get at least at the end of the tenure, I will get my money back. Term life insurance, if something happens, your family or nominees will get the amount, but if you survive, nothing will, the insurer will not pay anything. So because of that reason, term life insurance are not so popular in India. Only maybe 2 or 3% of the overall policies may be term life insurance. Others are unit linked insurance policies, ULIP policies, or it may be endowment, or it may be money back. Unit linked insurance policy is more like a mutual fund investment. If you take their market linked instruments, and there were amendment in the last year only saying that in case of ULIP policies, in case of unit linked insurance policy, if your premium amount is more than 2.5 lakhs, maturity proceeds shall not be exempted from tax under Section 1010D. If you see, for example, if you are making any investment in, if you're paying any insurance policy, whenever you get the maturity process, there is a specific exemption under Section 10, subsection 10D, clause 10D. But in case of ULIP policy, 2.5 lakh rupees is the premium which is paid in any of the for any of the year during the policy tenure. You are not entitled for the exemption. That was the amendment which was made last year only. But now they have included all policies other than ULIP policies. If you have endowment policies, any other policies wherein the premium exceeds rupees 5 lakh. During that, in any 1 year also, if the amount of premium is more than 5 lakh, if you have insurance policy of 15 years, and any one financial year, if the amount of premium is more than 5 lakh, the maturity receipts in the year in which the amount the insurance company pays to the policy holder, it will be taxed in that year. However, this is not applicable in case if a person dies during the policy period and the amount is given to the nominee, it is not taxable. So in case if your premium is more than 5 lakh rupees on any other policies, now the maturity proceeds is taxable. Now these were the provisions, I mean, these were the amendment which is proposed for the individual class of taxpayers. Now we will see what are the proposals for business income. And for business income, this is an SEZ units which are entitled to claim the exemption under 1010A. There are a couple of investment who are SEZ units. There is an tax holiday for a period of 15 years. But there are a couple of conditions which are added now. If you want to claim the exemption under 10AA, you have to file the tax returns within the time limit prescribed under subsection 1 of 39A. Original tax returns, if you are filing belated tax returns, the exemption will not be allowed. And if you SEZ unit which is selling the goods or rendering the services outside, obviously it has to go outside India. Your sale proceeds should be realized within a period of 6 months. These two conditions were not there in under Section 10AA. This they have introduced now. This is for SEZ units which are claiming deduction under 10AA. Startups, there are a couple of amendments which are contained under section 80 IAC and also under section 79.
You need to move the slide, Sidhu.
I'm on the startup.
Now it came. Okay.
Yeah. So under startup, see, for example, in case if you want to carry forward the losses, there is a condition which is prescribed under section 79, which says that at least 51% of the shares which should be beneficially owned by the same person who were the shareholders in the year in which the losses are incurred and in the year in which the losses are proposed to be set off. For example, if I have the loss of for financial year 17-18, I have a loss and I want to claim it in this 22-23, I have a profit and I want to set off that loss against the income of this year. So at least 51% of the shares in that year and this year should be same. On the last day of the previous year, it should be same. These were the provisions which were contained under section 79. But in case of a startup, particularly for unicorns and all those things, they will have a series of funding, Series A, Series B, and all these fundings will be there. And over a period of time, there will be a dilution in the equity holding, 51%, less than 51%, invariably it happens. So a few years back, the amendment was brought in section 79, which says that it is not necessary that 51% of shareholding should be there in the year in which the losses are incurred and in the year in which the losses are proposed to be set off. 51% criteria is not applicable to startup, but shareholders should be same. ABC are the shareholders in the year 17 and 18. Those ABC shareholders should also be there in the year 2022-23. CD may also be there, no problem, but ABC should be there. This is a condition, and the proposal was there. This was applicable only for carry forward of 7 years. And there is one more section, section 80 IAC, which says that in case if any profits earned by the startups, eligible startup means those startups which are registered with DPIIT, which has the startup recognition from the Interministerial Board. So for them, the deduction was allowed, 100% deduction was allowed under 80 IAC for a period of 3 years, consecutive 3 years in any of the 10 years. So in 80 IAC, it was 10 years, but in section 79 for carry forward of losses, it was 7 years. So bring the parity between these two. Now they have amended section 79 to say that the carry forward of losses, instead of 7 years, now the proposed limit is 10 years under section 79. And 80 IAC, the startup was supposed to be incorporated or registered before 31st of March 2023, 1st of April 2023. Now this has been extended to 1 more year. Last year also it was extended. In this year also it has been extended. Now, so any entity which is registered as a startup, which gets the startup recognition from DPIIT, if that registration happens before 1st of April 2024 or 31st of March 2024, still it is eligible for deduction. So now MSMEs, there is some good news, particularly for those who are operating in MSME.
Sidhu, sorry, can I just go back to one slide, please?
Yeah.
I'm sure there would be many people in the startup industry who might be listening to this. The advantage of looking at the startups where you get an exemption is twofold. If you just see the year 2022 in the government, 80,000 companies registered under the DPIIT scheme. There may be hundreds of startups, but 80,000 companies registered under the DPIIT scheme. That means 80,000 companies would get the tax advantage. That is the smallest of the provision. There is no big deal in a tax advantage because many of them don't make profit at all. But having said that, what is the fulcrum and purpose of doing this is all the companies, all these 80,000 companies which are registered under DPIIT have the IP in India. There is no IP drain which is going to US. For example, there would be a fund which is funding money in a startup in India until the IP should move to US. They were circulating the entire IPs and going and setting in the US while India used to have an IP drain. Now, all the 80,142 companies or 80,100 companies which are registered under DPIIT getting the tax exemption retain the IP in India. Sidhu, just be mindful of the time. I think it's already 4:30. We may need at least 5 minutes for Q&A. Till what time the seminar is there? Is it till 4:30?
Sir, including the web, Q&A, we were planning to have it till 4:45, but we can also extend for another 10 more minutes, sir. That is okay with you.
We'll try to push it faster. We'll give some time for Q&A.
Yes, sir.
Yeah, because there are a lot of provisions which are. This is one more thing. Section 43B certain amount of payment expenditure is allowed a deduction only on payment basis. For example, employer's contribution to PF, ESI, and all those things. If you pay even, then only you will get the deduction. Now, any payment made to the MSME, the entity which is registered under, which is categorized as micro, small, and medium scale enterprises, the deduction will be allowed under 43B only on the payment basis. It is not allowed on the expenditure basis. This should be mindful. For example, I am Guru and Jana, Chartered Accountants is an MSME, and I am rendering services to a company, some other audit services to the company. They have to pay me the fees before within the time limit prescribed under MSME Act, which is around 45 days. If they don't pay it, that income, that expenditure, even though that expenditure is incurred but not paid, it will not be allowed as a deduction. It will be allowed in the year in which it is paid. So this the companies, particularly who are having this business income and all, they should be mindful. And there are a couple of deduction on 35D, 28. I don't feel this are relevant because due to in the interest of the time, I will see there is one important amendment under section 56(2)(7)(b). Under section 56(2)(7)(b), in case if any company is issuing the shares for a value which is more than fair market value, the differential amount is treated as a income from other sources. For example, my fair market value is 100. I am issuing the shares at 120. 20 rupees was added to my income under section 56 as income from other sources. But those provisions were applicable only where the shares are issued to resident investors. Now this has been extended to non-resident also. In case of any subsidiary is there in India and a holding company is investing in Indian company, the shares should be issued at fair market value, and the fair market value has to be determined as per Rule 11 UA by discounted cash flow methods. So there is already a lot of controversy which is revolving around it. This is popularly known as angel tax. Whoever has suffered this in income tax scrutiny and now would be aware. So this was applicable only where the shares are issued to resident. Now this has been extended to non-residents also. A couple of TCS provisions are there.
Sorry, Sidhu, the only concern in 56(2)(b) is the worry we would face is the foreign money coming to India was becoming extremely good. We got only in 21-22, it was $83 billion. And in 122 alone is $83 billion. And if the foreign money coming into the country is getting taxed under this provision, it is very surprising that this provision was introduced. We expected that they would remove more benefits, they'll allow people to come from foreign to India. One possible explanation could be China investments has gone down, and other than India, Manila and Sri Lanka investments have gone down. So investments have to flow to India or Brazil. That could be one thing on the hindsight, but not a great move. It is a move which could dampen the foreign investment to India.
Correct. Wherever foreign money is also coming into India, now they have to test this fair market value. Again, that similar litigation is there. Your entire valuation report is questioned by the tax authorities. That will continue. So TDS provisions, only the relevant provisions I will take off.
Sidhu, maybe you can skip the TDS provisions. We'll go for a Q&A because we have only 8-10 minutes.
Okay.
Sir, if any questions are there, you can go to Q&A, Sidhu. There are some questions there. You can have a look at that.
Sure.
Sir, before that, we have a couple of polls that we want to run. Can we do that before taking the question, sir?
Yes, please.
Yeah. Hello, everyone. So we have a couple of polls just to understand our audience and what to think of the union budget. So let me run the first poll. I hope you're able to see the poll. So
No, sir, we're not able to see the poll.
sir, you are organizers, sir. So only the
So we
audience
can't see it. Okay,
yeah,
okay, sorry.
Yeah, no problem. Okay, and I'm running the second poll now. So So as people are dropping in their choices, so I would like to ask Mr. Guru and Mrs. Siddanna about a personal question. So first thing that everything that comes into the employee mind is which tax regime is better for me, whether it is old tax regime or new tax regime, and how to find or how to choose which tax regime would be beneficial for me as an employee. So this is one common question that everybody has, even I have. So we can maybe start with that question and see how we can go ahead with that, and then we can slowly take the questions, because that is one of the popular questions in the questions tab also. So yeah, I'm
Yeah,
just closing this.
yeah,
Yeah.
this question is itself is quite subjective. See, all depends upon the deductions what you are claiming. So I think in case if you are in the middle income group for up to say 20 lakh rupees, and if in case if you don't have any much of the tax deductions in HRA or ATC ATD, I think the new regime would make sense for you. But in case if you have a good amount of deduction which you are claiming for HRA and other things, and in case if your total amount of deduction itself is around 3.5 lakhs, so I saw somebody has done some analysis on it, and as per their workings, in case if you have the deductions of more than 3.6 lakhs, new regime, old regime would be still beneficial for you. Otherwise, new regime would do good. But it again depends upon your individual exemptions and other things. But there are so many tools which are available on the public domain. You can just key in the numbers.
Just as an add-on to what Sidhu tells also, you'll have to consider what is your age factor. If you are a person who is below 40, it would be definitely, if you can remove the equation of taxation outside, and whichever level of income you are, if your income earning outside in the market instruments is much more higher than the Chapter 6A instruments or a deductible instruments, anybody below 40 would prefer to go to the equity market and take the risk there, because sometimes the returns can be 25% to 30%. And if you are very smart enough, much more. So instead of putting money here at 3.6 lakh or 4 lakh of rupees, even a decent mutual fund is giving a instrument return of at least 12 to 13% even in tough times. So as a long player, if you're below 40, my gut feeling is go to the new scheme, ignore the deductions and just invest in the market and take the risk. If you're a little more older, above 45 and things like that, go to the old scheme, don't take too much of risk in the market.
Yeah.
Okay, sir. Okay. I guess at least from my personal, I have to do a little bit of homework and see what more I can do. But yeah, I guess this is beneficial for everybody who has these questions on their mind, sir. So, sir, on the left, you'll be able to see the Q&A questions, and you can filter out as per priority, which we have prioritized the questions, and you can take forward with the questions, sir.
Yeah, sure. I was just seeing the questions.
Yeah.
Audio is not clear.
Sir, on the top, can you see the filter option? Click on the filter and click on prioritized, sir.
So old regime, new regime, we have answered.
Yeah.
Services to primary and secondary educational institutions or GST exams are there. I don't think there are any changes in it. GST, only few changes were there because most of the GST are through the clarifications in the GST council meeting. There is nothing new in the budget as such, but there is only one thing which I had to discuss with you. In case if you are for a company, the company has to spend CSR, spend on the CSR activities. As per Section 135 of the Companies Act 2013, you are supposed to mandatorily spend certain amount of time, certain amount of money on CSR spending. In case if you are spending any amount for CSR, any GST on the services or the goods procured for the purpose of CSR is now blocked. You cannot claim the GST credit for that. See, income tax also, this expenditure is disallowed. Specifically, it is there in explanation 2 to Section 37. So income tax also you cannot claim the deduction, and the GST on the services which are availed for the purpose of CSR activity, you cannot claim the ATC credit. This is an amendment to Section 17, subsection 5 of CGST rules, CGST Act. And standard deduction is still there in the new regime. Standard deduction is there now in the new regime. It was not there in the new regime. It was not there earlier. Now they have proposed the standard deduction.
So there is one question from Ravi Kiran who has asked the same question twice. It reads out like this: can we shift between old and new regime every year, or only one for once in the below two cases? Individuals with business income, individuals without business income.
Individual with business income, you can switch only once. You can switch once, then it is gone. You are out of it. But in case if you don't have the business or professional income, every year you can do it.
So LLP taxation, ULIP taxation. I'm sorry, I read it as LLP taxation. There's no changes in taxation of ULIP taxation.
ULIP, that insurance policy, if the amount of premium is more than 2.5 lakh, maturity proceeds are taxable now under Section 1020. That was there earlier also. Shift between the new regimes. So people having the housing loan and savings under 80 can go to the old regime only. It depends again. In case if your income itself is around 15 lakh rupees and the amount of interest is lesser, new regime would still make the sense for you.
There is another question which is coming as foreign remittance received. Is it compulsory to deduct tax or no? When you are receiving money from outside the country, we cannot deduct tax here. It is income in your hands. Lavina Jain has asked that question.
Yes. Guru, there is one thing. You see, in case if you are sending the money outside India under
LRS,
the banker would collect the tax in addition to the amount whatever you are. So, for example, if you are remitting around 10 lakh rupees, banker would collect 5,000 rupees extra as TCS. So that now that limit has been extended. It was earlier 5%. Now that has been increased to 20%. However, 5% is still there when you are sending the money outside India. LRS through LRS scheme for education and medical. For education and medical, it is 5% with a ceiling limit of 7 lakh. For other purposes, there is no ceiling limit. TCS banker will take 20%. That is an amendment. It was there, but unfortunately, I was not able to discuss.
I am a freelance consultant. I fall under the tax slab of 15 lakhs or more. Which regime should I opt? Sidhu will answer, but I would go for 44 AD and just use it better, because on 15 lakhs, if you are a professional, you pay tax on 7.5 lakhs. Professional is defined like an architect, chartered accountant, etc. If you are a freelance creative designer or something, you should only pay on the 8% on 15 lakhs. That means only on lakh and 20 you pay tax, you come below the taxable limit.
In new regime, Mediclaim, ATD, LIC, PPF, ATC are not available. So isn't it that is a disadvantage? Obviously, that is a disadvantage because as I told you, government is now promoting because people should spend only then the economy will grow. So I think that is the objective. This is more of a growth-oriented scheme. ATCCH, whether the fund is available to the general public? No, ATCCH is for only for armed forces who are enrolled in Agnipath scheme. Considering the changes provided only in the old regime, suppose if the income and the deductions are same both for 20 budget year 2024, then there is no change in the tax liability. Considering the changes provided only to the old regime, no, the changes are provided in the new regime. There is no change in the old regime. Old regime still continues as it is. So the proposal is for the new regime only. Income tax exemption benefit for startups. Startups, I've told there are two MSMEs. That 43B is now introduced. So payer has to pay you, somebody who is paying to the MSME. In case if they want to claim the reduction, they have to pay it within the time limit which is prescribed under MSME Act 2006.
That is a very good provision, especially for MSME, because India has a large number of MSME customers. So if you are providing services to a X company and you pay a bill, and in case you don't get paid, he can't claim it as an exemption. Only if you get paid, he can claim it as an exemption. So that's a very good thing. So MSME law is becoming much better.
Yeah.
No changes in NGOs and trusts, sir, but you should expect some changes with reference to NGOs and trust in the process which is getting approved. It is becoming more and more digitized. It is becoming more and more dashboard driven. So if it is an NGO and trust, governance is going to be the rule of the game.
Yeah. Angel tax 56 is now startups. There is no change. Either startups are outside the angel tax regime, provided this is a registered startup. Any changes in TDS prescribed limit? There are few changes in the TDS, particularly for 194BB. There is a change. 194B for winnings and lotteries and all those things. Earlier, the 10,000 was per payment. Now it is overall 10,000 for the financial year. MAT applicable for ATIAC deduction.
Sidhu, you should go full down. In the last rows, there are a lot of questions. Come to the end. I have 8 branches in 8 states, MSME registered with 1 state. Will I get the benefit in all the states? It depends on what benefits you are looking of. If you are looking at income tax benefit where tax deduction will not be done to the company you have supplied, he won't be able to get the deduction of his company wherever he is, irrespective of which branch you are working on. But the other benefit you can look at is if your customer doesn't pay you, then the local MSME department is become quite active. You are getting settlements within 6 to 8 months.
Yes. There was one question on 80 IST for AMT, alternative minimum tax under 115 GST. That will continue. It was there earlier also. There is no change in that. Kindly answer. This is Matt S. Matt have answered. Crypto tax, there is no change. We are getting FDI from our holding company, shares allotted 950, and if the shares are issued at 955, yes, then that 5 rupees differential amount is taxable. Please make sure that the shares are issued at the valuation as per the valuation report.
See what happens here, whoever is Sushma TR, there is a concern there from the income tax angle and the Foreign Exchange Management Act. Now, what the Foreign Exchange Management Act tells us, if the parent company outside India is putting money in the subsidiary in India, the money has to be put over and above the valuation price. But the income tax is now telling anything more and above the valuation price, will tax it. So we are expecting some clarificatory notes there, because both the central laws are contradicting to each other. But I would expect that they would bring in a sense of reasonability there. If it is 950 and if it is issued at 975, or some 10% they may tell, and it's okay. If it goes beyond that, they may plug it in, because the forex laws are much more tougher than the income tax laws.
Right. The rebate under section 87 is applicable only for new regime up to 7 lakh. And what is the old regime? Old regime, it is still 5 lakh rupees. That will continue. NGOs and trusts, there are few changes procedurally, which we could not discuss, unfortunately, but there are no significant changes.
So there is a question on 44 AD and 44 ADA, example teaching and consulting. How do we differentiate between the business or profession for 44 AD and 44 ADA, example teaching and consulting, asked by Pradeep Anand?
See, under 44 ADA, the word profession is defined. The definition is there under 44 AA, particularly for those who are engaged in accounting or law service or consulting engineer and other things. Unfortunately, teaching, I don't see teaching is covered there. So, in my humble opinion, it should not be a profession. It should still go as a business income.
We'll take another 2 more questions and then we can wrap up this session. So in case if you have any questions, just drop in the questions tab.
There is only one question, sir, which is that one thing which is pulling back the government to give tax-related benefit to decent salaried class. Value salaried class is just being harassed by levying more and more tax. I mentioned those employees having salaries of more than 50 lakhs. See, if you look at the situation in the entire sector, you will do what is easiest for you. Collecting tax from a business enterprise is that much more tougher than collecting tax from a salaried enterprise, because there is a definition. In a business enterprise, there is no definition. The business is so volatile. At any point of time, we don't know what would happen, which goes up, which comes down. In a salaried class, the salary remains stagnant for at least the increment period goes in. That is one logic which I could attribute where a salaried class do pay. But unfortunately, world over, it's not just in India, world over, salaried class are the people who suffer most, because the avenues of tax planning is so less to salaried class. Even if it is an ethical business and morally run business also, there are enough of tax planning avenues. But at the same time, if it is a salaried class, it can become quite difficult. To articulate my point, if you go to a startup and you get an exemption for a startup and it's already making profits, even after making profits, a startup doesn't pay tax. But if an employee is working in a salaried company, which is a startup, he pays the normal tax. So there are dichotomies, there are issues in that point. But I would subscribe only to that point that salaried class are targeted every time, which is true. But at the same time, the tax rates have fallen down dramatically also. Of course, manufacturing sector is 15% in new manufacturing sectors because they generate employment. But the tech employees, the salaried employees are the guys who are actually tech guys who contribute so much to the country. They are actually pushed hard because the company doesn't pay any tax in most cases. If you see any tech company which has got a parent company in US, you take for example Google or Facebook or any of these companies which have an offshore center in India, their cost for India is 100 lakhs, 100 crores per annum. They pay tax only on 15 crores, and that too they pay only 25%. So if they're doing 100 crores expenses, they pay tax on 15 crores, that is 3.75 crores only they pay tax. While the total value of business is 115 crores. That is where tech employees are working in these companies. As companies don't pay taxes, tech employees end up paying taxes, which I fully agree that it is not the fairest aspect of it, but the law is such that it doesn't look at fairness.
Yeah, thanks, Guru. There is one more question, which is the last question I will take up. A startup benefit can claim can be taken 3 years consecutively for 10 years. Is there any amendment to it? There is no amendment to this under 80 ISC. You can still claim the deduction for 3 consecutive years out of 10 years from the date of commencement.
So thank you, sir, for your time. I am sorry we took 9 minutes extra. Apologies, and thank you for giving us this opportunity.
Thank you, sir.
It's always great to have these discussions, especially when it comes to money from both business angle and personal angle. So we would like to convey our heartful thanks to both Mr. Guru and Mr. Siddanna for taking the time to give insights on how the union budget will impact on both businesses and on personal income taxpayers. For the audience, thank you so much for taking your time. We have recorded this session. We will share this recording with you in 3 to 5 business days. Thank you so much, everyone. Take care and stay safe.
Good day.
Thank you.
Bye.